Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen, your host, and joining me, as he always does, is Irusha Paris. Now, we're doing something a little different this time around because this is going to be dropping on June 13th, 2024, but we're taping this a little early because hopefully at this time, I'm in Costa Rica. Our producer is off gallivanting. We're doing our vacation time, so we're getting this prepared for you ahead of time, keeping it a little evergreen for the lessons that we've learned over a lot of trading years. We've got, of course, myself at 27 years. Where are you at now, Irusha? How many years for you?
I want to say like 24, 25.
24, 25 years.
Yeah.
Okay, good.
Yep.
A good quarter century. And then, of course, our special guest this week, David Saito-Chung, back on the show. He is the deputy markets editor at Investors Business Daily. And I want to say you're approaching 30 years of investing at this point, right, Dave?
Getting close to 30. I think I'm kind of splitting the difference between you and Irusha. Probably 24 to 25 years of IBD style trades, tribulations and triumphs, plenty of tribulations.
Yes, right.
I was going to say, David looks like he's 30 years old.
Got to credit the camera, work, and the producer for that. Thank you so much.
What filter are you using?
That's right.
Well, and to that end, I mean, Dave, when you were kind of, when was it that you were in Japan, kind of covering the financial markets there? Because you had kind of a very unique experience in terms of a lot of knowledge coming from a foreign market.
That is right. I covered the Japanese stock market from 1998 until the end of that year, and that was a tumultuous time. We're talking about the Nikkei 225 at around 12,000, and this summer it's likely that the Nikkei will try to test that 40,000 level again.
Wow. Right.
Wow. That was an incredible time to start my career in stock market journalism, Justin, because we saw global markets really fall hard. Back in 1998, Reuters called the global bear market sort of like first of all, the Russian bear whacks all markets around the world.
Right.
With the ruble crisis and then the blow up of long-term capital management. So that was a very interesting time.
Yeah. Now for me, that's I was about a year into my investing at that point. And so I feel like I had just gotten my head wrapped around the concept of the follow-through day. And of course, we had a follow-through day back then in September of 1998. And I kind of went heavy on that because, again, it was like one of those things where I was like, oh, I get it now. And this is the follow-through day. Let me buy. Now, granted, I didn't have that much money, and back then this is when you had to, make the phone call. We were actually trading through StockMart at the time, which was William O'Neill and Company owned brokerage. So we would basically be calling someone upstairs. Robert was his name, and I'd put the trade in and stuff. And the commissions were $30 a trade. So you had to put that into consideration. With only a few $1,000s, that I was working with, it was kind of like, okay, you didn't want to do too many trades, but I did a lot of buying on that September follow-through day, and then it failed. And I'm like, oh, what now? Like this, I hadn't put that into my equation yet, that they fail. In fact, it not only did it fail, it failed brilliantly because there was this really ugly double bottom that got created at that point. Another leg down as the news just kept on getting worse and worse. And then it was, oh my gosh, we could have an economic crisis. The financial system as we know it can freeze up. And that's when in October, there was another follow-through day, and I didn't buy a single thing on that follow-through day.
And I just pulled it up on the
we can take a look at the chart.
The 1998.
Yeah, this was definitely a big lesson for me because on that follow-through day that we had in October, that's when Charles Schwab came out, AOL came out like a little bit later after that. And again, I didn't buy anything because I'm like, oh look, you fooled me once, in September, and with the headlines as bad as they are, there's no way I'm getting in. And that was a big lesson for me in terms of, hey, you buy something. And again, I was in customer service at the time, and we got the benefit of sitting down with Bill and every now and then, and he would go over some of these concepts of the market. But yeah, that was a big learning lesson for me. And you were, you were on the other side of the world there, kind of dealing with this in the Nikkei, right? And also
Totally,
a lot
yes.
In the
closer
middle of
to,
it, right?
I mean, because
Yeah.
with the Russian ruble, then it was also a lot of the what was it, Indonesia, a lot of the Southeast Asian currencies came under a lot of pressure as well. So that
They
was a
did.
really
It was only 1 year before that. Korea went to the IMF hat in hand for a
Mhm.
bailout. So it wasn't just South Asia. It was the Asian contagion,
yes,
Justin
right.
and Irusha.
Yep.
And
Yeah.
I'll just never, just like you never forgot the experience of buying stocks in the IBD methodology on the fall today. I'll never forget just a shock across the city of Tokyo when two major financial institutions went under. One was one of the largest brokerage firms. They were caught cooking their books. And then
Wow.
another was the Long-Term Credit Bank of Japan, which was formed right after the war to help with the reconstruction. They had just too much debt that they couldn't pay back. So that caused kind of a similar just a twin sell-off, if I remember correctly, back then. But as we all know now, that through those crises come
Yeah.
opportunities, and that's what's a timeless lesson for all three of us, right, Arusha?
Mhm.
Yeah, yeah. I mean, I think it was only a little after I think I really only just started investing in '99. But around that '98 time, that's also long term capital, right? Long
Yeah.
term
Exactly.
capital. They were investing in all these. They had the smartest people, all these PhDs, Black and Scholes, and or maybe one of them. I don't know if both were involved, but and they thought they devised a method where they really could manage risk, and of course, what the beautiful thing about the market, the black swan event happened, right?
Mhm.
That it was that '98 where it just kind of caught everything, and they were forced, and they were like going to bring down the markets too, and
Right.
the Fed had to get involved and all that kind of
Exactly.
stuff.
And,
That's
and
right.
and it was one of those things where it was, if I remember correctly, they had a system that was like 99% accurate,
Yeah,
99.9% accurate, but that one time it wasn't.
exactly.
It's
Which is great about the market.
that's the thing. And yeah, to
Amazing.
your
Yeah.
point, yeah,
Yeah.
Nobel laureates
Yes.
Laureates.
on their team there. So
Yeah. It was
Yeah,
um,
like the
and
dream
another big
team was
lesson, guys,
assembled.
was really the amount of incredible leverage that long-term
yes,
capital
Yep.
had, and
Yep.
it didn't take that much of a move. Although the move, for instance, in the Russian currency, the debt that just went belly up, issued by Russia, long-term capital invested in that. They were long, but because they were something like 20, 30 to 1 levered,
hmm
that it was even more that really caused their downfall.
Yep.
If they had made a mistake but had controlled risks, we
That's
we wouldn't have
amazing.
had this
hmm
conversation.
Yeah, it was
yeah,
like the opposite of risk management, apparently,
right.
right? It was like,
Right.
Well, because the reason
and
they had to use
ego.
that
It's
leverage, the
I
reason
mean,
they
it's
had to use
all
that
ego,
leverage
right?
was
Yeah.
because their profits on a lot of their trades, they were right a lot, but their profits
Yeah.
on the
We're
trades were
just
very
tiny.
small. So in order
Yeah.
to make it meaningful, a lot of
Right.
times they were using that leverage. And again,
Right.
it's all great as
Yep.
long as it's working.
Well, but I mean, but still, like, okay, I know your profits are that small. You really have to have pretty big egos to
Mhm.
think that, you know what, we can do 30 times leverage
Yeah,
and we're going to
right.
get away with it because we're so smart, right?
Mhm.
And we
That's right.
found a money machine, right?
Yeah.
I think that's and I mean that's one of those lessons. The markets are the great equalizer.
Mhm.
It doesn't matter your education, doesn't matter how smart you are. It's going to you're all we're all kind of trying to ride the same waves here, and if you don't know how to manage those waves, and if you don't know when not to push it, you're gonna find out the hard way that it's gonna be a very, very expensive lesson.
Or maybe not to go in the water sometimes.
Oh yeah, that too. Yeah.
So, hey, these waves are too big
fellas,
for me.
yeah, and just as a third lesson, because we are going back in time. I mean, it's amazing. This is, I mean, we're talking 26 years ago, but the fact that one of the founders of long-term capital was one of the star traders on Wall Street, John Meriwether of
Yeah.
then
Yep.
Salomon Brothers. He
Yep.
was the subject of one of the most famous books on Wall Street called Liar's Poker. John Meriwether, he had this $1 million poker game with this then CEO of Salomon. Here's a guy who clearly was a successful trader, but it's always about your next move and your next decision that really counts. So
Yeah.
I think that's something that we all should always remember, given that we've had real success in the stock markets for most investors especially since the end of the pandemic bear market.
Yeah.
Well, and what's interesting too is there were some lessons I think to be learned from the trouble that long-term capital management got into with recognizing, hey, you've got to, there might be an infinitesimal chance that this happens, but you've got to put into your equation, what if this, what if bad stuff happens? How do I unwind my positions? Because I think that really came to bite a lot of people when we had these unusual derivative products, new instruments that were being created during the housing bubble, and that kind of got a lot of people into trouble, because some of these products were predicated on, well, as long as the housing market continues to go up, these are going to be fine. No one's going to, these collateral debt off, all these, unusual things that people were engaged in, and ways in which they were structuring the subprime debt. It was all fine as long as the market was going up, right? As long as the housing market was going up, as long as, hey, no one's going to be foreclosing. Again, it was that risk management that nearly brought the system down again.
And I think that's what the nice thing about IBD, because I started out as a subscriber, and really for me, the beginning was, so 99 was kind of when I just had a little bit of money in the market and things were going great. I was like, oh, this is easy. Then 2000 rode it all the way back down. I was like, okay. But really what attracted me to IBD was they actually were preaching risk management, cutting your losses. And I had never heard that before. It was just like, know when you're wrong. Like, just like Justin was talking about, you have to know when you're wrong and what to do when you're wrong. And that way you're going to survive. And so that's one of those big lessons that I was lucky enough to learn early on. And really those first 2+ years of trading, learning from IBD, reading the books, going to a seminar with Bill O'Neill, and was just selling. Because I didn't know what a bear market was, but I'd try something and it'd blow up, try something and blow up, and just learning those 8% rules. But the way I learned kind of that, just very quickly, but the way I learned the 8% rule the hard way was with Skechers. I bought Skechers, I think in 2001. It went up. I was up 25%, and Bill had a rule, when you're up 25%, you should lock gains. I was like, what does Bill know? I'm going to keep holding it. A lot of people are going to the Skechers store. Then it came all the way back down. So I round tripped it. There's another rule. If you round trip it, just sell it. I'm like, this Bill, whatever. Down 8%, nah. And then all of a sudden, I was down 70% on the stock. And so, and this was a bear market. I had no idea. And so then I was like, oh, that's why they have the 8% rule. Because it's a lot better than having 80% loss, right? So those were those kind of valuable lessons that I've never kind of forgotten, because you have to kind of put your hand on the stove, learn the hard way, but defense first. And that goes back to football and stuff like that. I always love the defense. Defense wins championships. Defense first. That I think is one of the biggest lessons. And for me as an investor, because how many once in a lifetime type of events have we seen in the last 15 years, right?
Yeah. Opportunities and devastating, once in a lifetime things.
Exactly.
Yeah. Dave, how long do you think it took you to kind of get to a point where you're like, oh, I feel like I'm getting it now? Like, I don't think I have even gotten to that point where I'm like, oh, I'm a master. It's always
Right.
like constantly learning and everything like that. But was there a time where you were like, oh, I feel like I'm kind of clicking and I understand what I'm doing and I'm understanding the mistakes. How long do you think
Mhm.
that took you?
Such a great question. And first off, I'm like you, Justin. I will always consider myself a student, never
Right.
a master. In my mind, Bill and some of his best performing portfolio managers were true masters of the trade, and they did it for a living. Um, as a journalist, but also very eager to learn how to invest with my own funds, and being surrounded with this kind of content, it took about 4 years.
Hmm.
In 1999, in January, I joined the company after being a reporter and a correspondent in Japan, and I didn't make any trades, and partly because a lot of money was going toward childcare
Yeah.
and just moving back to the U.S. from Japan. And so I just observed what was going on, and what a year to observe, right? The dot-com bubble and then the crash. And then in 2000, I made a few trades, but always respectful of the IBD perspective that we were in the middle of a very bad bear market.
Hmm.
2001, funny how you had mentioned, Rusha, Skechers, that initially was a big winner for me as well, because it was kind of an easy to understand
Right.
company, right? Really popular shoes, and Britney Spears at the height of her powers and popularity was one of the most famous celebrities, and also a spokesperson for Skechers. And I got so enthused by that stock. I even went to the annual shareholders meeting in Marine Del Rey, and
Wow.
saw all the officers there, and decided to hold, even though the market showed some key sell rules, just like what Irusha happened. And I think I lost most of my gains after 9/11, when 9/11 closed the market for 5 days and consumer stocks got blitzed. That's an indelible memory for me, and just a lifelong lesson. Make sure you're taking at least some gains on the way up. So it really took, Justin, until the end of the 2002 bear market, and then early March, early April, and early May, when I had a little more money through savings,
Hmm.
to start investing. And 2003 was a landmark year for me personally. These were, again, not big amounts of money, but I still remember being up almost, I think, 210% in the year 2003. And so
Hmm.
I was really excited, and I felt, okay, I think I really uh, understood a lot, but I was still obviously making mistakes
Yeah.
over the next 10 years. And, later in this podcast, I want to share one example of a lesson that I learned that I should have known, well before then, but have never crossed that rule again in my own trading.
Hmm. Well, we're going to take a break. And when we come back, we're going to hear about some of the trades that David learned from, the good, the bad, and maybe some of the ugly. Stay tuned. We'll be right back. Welcome back. It's the Investing with IBD podcast. One of our special episodes. We're taping this a little bit early because a lot of us are going to be on vacation. So we're still getting our content out to you. And we're here with Irusha Paris talking about some of the learning lessons of our past trades. And of course, we've got David Saito-Chung also joining us from IBD. He's the deputy markets editor and sharing some of his experience as well. And we just kind of went through some of our market experiences, early experiences. And Dave, I got to say, I'm right there with you. I probably would clock myself at 6 years before I could say, oh, I think I'm learning it now, because the first 3 years were almost a wash because it was the late 90s when I thought I knew everything. And
Hmm.
then I realized how little I knew. And then, of course, the bear market, was, between 2000 and 2002, the bottom was rough. And it's funny because I got out great in 2000. I really, really got out well. But man, there were a lot of those going too hard, too quick, in the bear market, where that's where I lost my money. I was down maybe 10% from the top in March 2000, but then by the time the March 03 follow through happened, I was down over 50%. Now, granted, at that time my portfolio was small, thank goodness, so it wasn't too hard to come back from. But yeah, 2003 was okay. Now I'm able to put these lessons into play. But let's fast forward a little bit to kind of as you said, we're all still learning. We're all still students, and there's no such thing as perfection in this game. It's really about, okay, doing that post analysis. What can you learn? So what's some of your post analysis uncovered for you in terms of some of the recent things for you, Dave?
Well, looking at a few recent trades, like literally over the past several months, I wonder if we could take a look at, for instance, ARM Holdings, ARM.
Mm-hmm.
And speaking of mistakes, you're absolutely right, Justin. In fact, I had lunch with a mutual friend of ours recently, Alex Marenko.
Oh
Alex
yeah.
Marenko being right, former portfolio manager, former trainer, actually for Bill O'Neill as well. And he was trying to explain what IBD style investing is all about to a newbie, and he said, "We are in the business of making mistakes. You're just going to have to accept you're making mistakes." And a mistake could simply be, okay, you bought the stock, you're down 7%, you cut the loss. That's a mistake because you went in there trying to make money. But the mistake I want to show you is not getting back into what turned out to be a wonderful gainer over the past 5-6 months. So
Mm-hmm.
I took some notes on this trade, and ARM, obviously not an IPO for the first time. It actually came back to the public market after being held by SoftBank CEO, and the stock really had just a so-so start after the IPO at $51, formed that kind of base that was at the time just an ordinary cup with handle. Nonetheless, cup with handle that formed 64.92 entry. I started buying it at the end of November, made just a few shares as a scalp buy, and then really put on a little bit more size on both December 12th and December 15th. And if you look at a daily chart, that was pretty much when it was breaking out of this cup with handle at around 65. But one thing that I should have done was not look at it too often. And the stock, even though you can't really tell on this chart because of the scaling, it was very volatile. It could move 3-5% up or down each day, and I got shaken out just 4 or 5 days later. Now, the there was a wash basically, but as you can see on that chart, not once did it violate any IBD defensive sell rules, such as cut your loss. It never fell below the 50-day moving average. It just moved kind of sideways for a while, but eventually got support at the 21-day exponential moving average. And then by the time that earnings were going to be announced in, I think it was early February, anyone who had actually bought correctly right around 65 would have had a gain of over 14-15% heading into earnings. And from my point of view, even for a newer stock, a tech stock, a volatile stock, to me, I think that's plenty of profit cushion to go into earnings. And wow, what a response! I mean, this looks like a true rocket ship, right? Right, guys.
Mm-hmm.
After reported a solid, Q4 earnings and sales growth, it jumped 47% on February 8th, and I wasn't there. I wasn't there despite the fact that I bought it correctly, and I didn't have the patience. So this happens when, for at least personally for me, when I have not done as much research into a company in which I feel like I should have a lot of high conviction. Why would I have conviction in something like this? Well, one, it's a newer issue. Two, it's part of this incredible new transformation of the semiconductor industry, and it's part of possibly this new wave of AI technology. And just doing even a little more research would have probably given me a lot more uh, willingness to be patient and just hold the stock, even though for weeks I would not have been up more than a couple percent.
Yeah. So do you, I mean, certainly the extra volatility that often comes with IPOs can be something that's difficult to handle. Do you kind of have different rules for IPOs that you use?
That's a great question. I think it's going to depend on the company. And one example is Nextracker. You know, NXT is a stock
Hmm.
I made some decent profits in NXT, and you know, this one perhaps makes ARM look like a Dow Jones stock, right? I mean, this one is just so off the charts in terms of day-to-day swings. Uh, so I never established the sort of size of the initial position in Nextracker as I had with ARM. And maybe that was my own mistake, because sometimes I feel like one of the biggest mistakes I have made over the years, despite having some success in the IBD methodology, is to n not have the same size position within my portfolio on that initial buy within IPOs, Justin. And
Yeah.
the reason is you just don't know which one is going to be a 10% gainer, or going to be a 5% loss for you, or a 50 to 100% mover. And you can see this one had a move. I felt like my entry was good because I traded the stock when it crossed a trend line within the base. I didn't buy it on an actual breakout to new highs, because thinking that this is, you know, a solar stock, commodities, probably a little more volatile, a lot of external news that could you know really make this stock hard to hold. Uh, that was a good strategy, but you know, in retrospect, I would have a much more satisfying, you know, return overall in the portfolio if I treated it with the same level of importance, or with the same amount of conviction as I did with ARM. And so, and then in reverse, maybe the position size for me in ARM was too big. Maybe having a smaller position, and then just maybe watch it once a day, or even just wait for the end of the week to see how it behaved on a weekly basis, could have been a better strategy.
Right. How about you, Arusha? Do you, you know, Bill often
Well,
said, you know, this concept of kind of starting all positions at the same level, you know, roughly is a good thing, because you don't know who the winner is
right.
going to be. You know, let the market tell you. Is that something that you employ yourself?
Um, Not always.
Mhm,
For especially like for IPOs, I will go smaller, and
mhm,
even for and you know, David and I kind of suffered the same fate with ARM. Um, I did the same. I did very similar kind of thing as David here, where I bought it well. I was in it for a bunch of this time, and I was kind of trading around the position too. And I think the key thing for me, why it was working pretty well for a while, was I wasn't watching it that much. So that volatility was,
yeah.
I was focused more like on Nvidia and some other stocks, right? And so like ARM kind of doing its thing. And so when it was when it kind of ran up to 78, I was like, oh, let me take some off. When it came back in, I was kind of like, you know, trying to do like Charles. When it pulled back, I bought my position back to a full position. When it traded up again to 79, I sold half of it, and I said, you know, I'll just, you know, buy it back when it came back in. But for whatever reason, I kind of lost track of the plan, and when it pulled back, I think I got shaken out and I didn't buy it back.
Hmm.
And when they reported earnings, I had forgotten that I did that. And so I still thought I had some shares. And I was just sick when I did that. I was like, it was
So,
like,
so you celebrated, and then you looked at your account and said,
I
"Well,
was
hey,
like,
why
"Oh,
am
I
I
think
not
I
going
was like,
up?"
yeah, I have some shares in this other account where I don't watch it that much." And
Right.
and so I think that's one of those lessons that I try to tell myself, is that it, the you have to, well, at least I try to slow myself down sometimes with selling, because sometimes, you know, you're doing like 20 different things, right?
Yeah.
Where we're not just watching the markets and things like that. So you almost have to manage your state of mine where sometimes maybe some other stocks are getting hit and you're like, okay, let me cut out that. But you're almost in this selling mode where, like, you know what, everything sucks now. I'm just going to get rid of everything, right? And it's so easy to just sell everything.
Yeah.
And so that's what happened with ARM, where I think I was just so distracted with a number of other things with work and all this kind of stuff that I was just like, you know what, let me just get out of ARM now, and then I'll buy it back when it pulls back. And then when it pulled back and did exactly what I was looking for, I forgot that part of the plan.
Right.
And I was like, I'll wait a little bit longer, and then it took off. So it's so you can in a second you can get out those positions, and you almost have to catch yourself. And that's why a lot of times, for the most part, I like to scale out of positions and scale back in them, and not try to do everything all at once. But almost always at the lows of markets or lows of pullbacks, I kind of panic out of these things too. So you almost have to that's kind of that knowing yourself and stuff like that, and trying
Right.
to do your best to kind of slow those down. I still haven't really been able to fix those kind of reactions sometimes, but being aware of that, I think, is a big lesson, because you almost have to, over a number of years, and you guys, 4 years, 5 years, kind of learning. And I think that's a learning curve for all of us, once we kind of wrap our head around it. But you almost have to go through a few cycles to learn how you react to stock movements, right? It's not necessarily just a stock, it's how you're reacting to these movements. So they're really volatile. Are you getting too excited when they're going up and down? So you have to almost catch yourself and kind of write some own rules for yourself to manage yourself, right? The stocks are going to do their things, but it's up to you how you manage and how you react in those kind of situations, because they're going to keep coming over and over again. And so, yeah, ARM was just kind of one of those spontaneous, I'm just so busy, I'm just going to sell it, and I'll come back into it later. And it was a huge mistake on my part.
Hey,
And, to
Irusha,
your point, a lot of times it's hard because, like you said, you had a plan
Yep.
that, oh, if it pulls back, if it does this, then I will do this. But
Yep.
sometimes it's hard to implement your plan. And you
Yeah.
have to recognize, am I asking myself to do something that I'm not going to do?
Right.
It's like, oh, hey, my plan is to do, 20 pull-ups tonight. Guess what? That's not possible.
I can tell you right now, Justin, just strike that from your plan.
Yeah, exactly.
Right,
That's just not possible right now. So, you have to
Yeah.
kind of make sure you're giving yourself something that you can actually follow. And
That's true.
it's also sometimes you can look back and say, oh, I should have bought on this pullback. I was thinking about that, but it's hard to counteract all the emotions that go in with the fact that you probably had a lot of things pulling back on you at the same time
Yeah.
that kind of caused you to lose your positions. It's not
That's
just
the
one
bigger
stock.
thing. Yeah, I mean, I'm able to do that. So that part of the plan wasn't fine. It's just those moments of weakness. It's just those kind of distractions, moment of weakness, where you just kind of lose sight of what kind of larger plan was. And David, you were going to say something?
Yeah, well, Justin's points were excellent, and on top of what I feel was a really a mini treasure chest of nuggets that you provided, Irusha, following how I muffed up ARM. And I just want to add just one extra lesson that may be helpful for a lot of people, and is that when I initially made the position a serious position with my portfolio, we're talking 10-15% position within my own account. I happened to be on vacation in Hawaii, and I didn't want to be in front of my screen the whole time. I just wanted to, spend a little time watching the market and then have some fun, right? So that actually puts more pressure on you to maybe trade or just make a decision based on a limited amount of time. In retrospect, I might have done much better in the stock if I totally ignored it, not even knew it broke out, and then come back from vacation well rested and ready to look at charts significantly, because you look at the action in ARM for almost 3 months. It was backing and filling. It was not making that big a gain, even though it might have meant a lot of anticipation and hype. But ultimately, the chart showed that there was support, and there were multiple times to uh, establish a position before this incredible move on earnings.
Yeah. Well, when we come back, we're going to talk about some of our good trades, get into some of those because those are the fun ones, right? So stay tuned. We'll be right back. We're back on the Investing with IBD podcast. Justin Nielsen here, along with Irusha Pires and our special guest, David Saito-Chung, Deputy Markets Editor at Investors Business Daily. And we just kind of covered some of the lessons from a recent issue, ARM Holdings. But let's talk a little bit about some of those. It's not just about focusing on what you do wrong and fixing those mistakes. That's a big thing to do. But sometimes it's also about recognizing when you're doing something right and doing more of it. So I think we all have experience with NVIDIA, NVIDIA being one of the best performing stocks of, this last decade. So David, why don't you start a little bit and, talk about your experience with NVIDIA and why you feel like you handled it good and maybe even some things you could have done better.
I think this is a great stock for all of us to talk about for sure. And if you don't mind, Justin and Irusha, we could possibly look at a monthly chart of this tech giant. And I have been part of the leaderboard team, which creates a model portfolio of leading growth stocks since 2011. And we used to have meetings once a week among a number of members, including a tech writer at the time who had suggested that we consider NVDA back in early 2016. Well, it turned out that that was an amazing breakout move in mid-March, initially not on heavy volume, although part of the base had formed in good volume. Initially didn't break out of that cup with handle, into volume until a week after, but that turned out to be an enormous move on over the next I would say 2.5 years, where the stock went from an adjusted price of $8 to almost 80. So ninefold move, and I thought, wow. Unfortunately, Leaderboard missed that move. We definitely don't want to miss this
Trader
one.
got it. We were buying right out of that breakout. And
in 2016?
In 2016.
2016.
Yeah. It was with Swing Trader had just launched, and it that was one of our first stocks that we had on, and we took our profits at 10%.
Yep.
Yay.
Should have started off with long-term trader.
That's right.
Yeah.
Oh, well, still a good swing trade is a good swing trade, and so I really thought that the next correction that happened with NVIDIA, in 2018, caused in part by the fear of trade sanctions, the higher interest rates, and Jay Powell really for a while jawboning the market down. It led to a great washout for NVDA, and then obviously you had the very, very brief but sharp bear market caused by COVID, right? Well, knowing that, okay, well, we had missed NVDA from that prior move, and having then really taking the company really seriously in terms of doing a lot of listening to the conference calls, understanding what they're doing to grow for the future. This turned out to be a great move after the April bottom of 2020. Stock broke out at around $71, and to this day, just in unfortunately only a few accounts that I manage, NVDA is still part of that account, and is now a 15-16 bagger from that initial breakout. And I think the reason that worked for me personally was that after really understanding why they're such an exceptional company, I felt that this is one that could be the one that Bill, if he were actively investing, would have held for a long time too. Now, of course, there were some major corrections, obviously, even after that breakout in 2020, particularly in 2022, when virtually all growth stocks fell 50 or 70% or more. But if you have enough of a cushion, and you understand that this could be one of those special stocks, even if you got out of the stock, you can always buy it
Mhm.
back, on a trend line break or a standard sort of breakout point. But another reason of why I held some shares in some accounts this such a long time for me personally was that I knew that Bill and others have had success holding the true winners longer than what the normal holding period would be for your IBD leader, right? We often say most of your market leaders are going to last, 18 months. Maybe
Right.
they'll be a little bit shorter. Maybe they'll be a bit longer, right? But then there are going to be a few that you can hold for multiple years. And when I was writing the book to commemorate IBD's 20-year anniversary, Bill told me, and he told me not to write this in the book, but he said, you know, we wouldn't have had IBD if I didn't invest in Pick and Save, and over that 7-year period held it for 7 years, accumulated a huge amount of shares. I mean, because that was Bill, of course.
Hmm.
But then he
Yeah.
said, he earned 25 million just on that one trade. It was that one stock, that one trade over multiple years that led, or at least helped lead to the formation of a new business newspaper. So that lesson has always stuck with me. And, going forward, my job is to help our readers and everyone else listening on IBD Live and this podcast to find those true life-changing, game-changing companies. And if you do, you give it as much room as you can. And of course, a lot of people have quoted Jesse Livermore and saying that, my money, the real money that I made was in my sitting, not my thinking. And of course, we can't stop thinking. We can't stop thinking about when is the next big bear market going to come. What stock could actually upend Nvidia or Microsoft or Apple or whatnot? I mean, those things are very important to think about. But over the years, over a couple decades of investing, I've really learned that your gains can really compound over time, in those magnificent companies. And out of, let's say, 300, 400 stocks that I've invested in, uh, only a handful are going to have that kind of gain. And so when you can see that and appreciate that, then I feel it gives you more more power to let that happen.
Hmm. Yeah. Well, and I've got to say, this is where sometimes it does come down to recognizing your own personality, and I know for myself, I can't hold through like what we saw in 2022.
Right.
I look back at that and I still say there's just no way. Even if you tell me what's going to happen afterwards, there's still going to be enough doubt that, like, when I'm down that much, I get too negative. Like, oh, this just hurts too much, to see where it was and how far it's come down. So yeah, you have to know what you're capable of. And maybe, yeah, if I socked it away into a different account and didn't look at it, that would change it. But look, I saw Bill do that with Apple. Even a lot of people talk about Apple as being one of his big winners, but he did not hold on to that consistently like he did with Pick and Save. With Apple, he if you go to the monthly chart on Apple and you take a look, his initial buying was in 2004, and you see that little that little double bottom kind of action that happened. Let's see.
Over here in 2008.
No, it was before
Or
that, like in 2006.
oh
Yeah,
oh
you
yeah
see
yeah
right
yeah
there.
right here.
Yeah,
Yep.
there
Oh
was a
yeah,
little double
yeah.
bottom there.
Great
And
double bottom.
I remember Bill saying, I think Apple's done. I think this is it. That was a good trade, and he was completely out and ready to call it quits. But then it came back, and so he was buying it back. And what happened a year later? Oh, they come out with the iPhone, and then of course there's the financial crisis. But then
Right.
when it came out of that, it was the iPhone, the iPad, and then they changed their name. They were no longer Apple Computer, because remember, that was their name, because
Yep.
computers was their main business. They took the computer off because their main business shifted. The revenue shifted from a computer revenue centric business to phones and the iStore and everything like that. But yeah, so I mean, I definitely have thought a lot about Bill. This past week was a year since he passed away, and certainly working with him as long as I did, I am very grateful for everything that I learned and what I got to just watch him do. But were there any particular lessons? I mean, Dave, you got to hear from Bill often. He would come into the newsroom, kind of talk about, what people should be getting from the paper, and it was kind of your job sometimes to take that wisdom and put it into a coherent and space concise format to bring to people. So anything that in particular that stuck out for you from Bill?
Well, being asked this on the spot, I think since we talked about Apple, NVIDIA, and Pick and Save, one, I think, timeless lesson is that he always wanted our reporters and editors to focus on the biggest stock market winners, which meant that you don't look for the stock that went below $1 or $5 a share. You look for the stocks that are big in every way. So big years of earnings growth and sales growth, a big share price. Don't be afraid of a stock that's trading at 20, 40, 200, 400, or in this day 2,000 a share, right? That the market just continues to confound a lot of people because they think that something that's cheap or at a bargain price is truly a bargain, whereas what we're trying to do is to invest our hard-earned money in the most magnificent, excellent, and premium price merchandise, because even at that point, because no one really knows the future, that a high price stock could in fact be a true bargain because of uh, the many fold moves that these companies have had. So I think he never talked about, oh, this stock is really cheap and it's going to turn around. He was always looking for something that was incredibly innovative. And Justin and Irusha, we all noticed going back 60 years when he invested in the birth control pill company, right? With Syntex, right? That was a stock that he didn't initially buy on the first breakout, but when it hit 100, when it hit that century mark, and then he made a fortune, and that fortune helped him, buy a seat on New York Stock Exchange at a record young age. I mean, it's just there's so many examples over and over that no one can refute. So I think that spirit of Bill O'Neill still lives on within IBD and all of its products. That we are truly looking for the highest quality growth stocks, and we've built up so much experience and data and know-how, and I've got a great team that I feel like even though Bill passed exactly a year ago, at the age of 90. A lot of us have truly instilled his wisdom, spirit, and his constant search for something excellent. And as a result, I feel like many people are going to have their own huge Bill O'Neill kind of success going forward.
Yeah. What about you, Arusha? I mean, you got to spend more time with Bill's son, Scott, and you still do, and you are still at, O'Neill Global Advisors, and where that legacy is continuing. What kind of things are some of your takeaways?
Well, I mean, the first one, just when I went to the seminar, and Justin, I think you were in the back during that time
Right.
in
Putting the
2002,
slides
putting up,
together and
exactly. But just remembering hearing him, just like, you're going to make mistakes and learn from the mistakes, right? He was so positive, right? He was always like, you can do this, you can, you just anyone can do this. You just study history and kind of what David was talking about. So just having that him giving the confidence to everybody, and putting it all out there, right? He gave an actual structure, and it was pretty detailed, and it was a roadmap that you could follow through every cycle. So that was really the first thing. The second thing was at the end of the seminar, I got the courage to go up to Bill when he was about to hop in a taxi, and I talked to him, and he signed my book, and he said, "You can do it." It was the second edition of How to Make Money in Stocks, and I told Bill, I said, "I want to work for you one day. You know, that's my goals. I want to work for you. I want to be a PM there, and stuff like that." And he said, you know, he said, okay, he said, just write me. He's like, you know, just write me a letter. Just write me a letter when you're, you know, ready to move to LA and stuff like that. And I remember thinking, I was like, you know, write him a letter. Like, what? It's like, you know, and so I was like, I can't write him a letter. I'm not gonna. No one. He's never gonna get that. And when I finally got over, like, you know, 7 years later, when I finally got in, and I was working for Scott with Daily Graphs at that point, I started talking to some other people. "Well, how'd you get in?" And a few of the people at IBDs, "Oh, I wrote him a letter, and Bill called me." And so I think that's, you know, here's this amazing investor, an amazing entrepreneur, very successful business person, and he still was always humble enough to stay grounded. And if someone wrote him a letter and was looking for an opportunity, he would actually call these people up, you know, if there was an opportunity. And himself, he actually would call them up and say, "Hey, I have this opportunity. Would you like to come and do this?" And yeah, that's unheard of, you know, these days, you know, having someone at that, you know, at that level, that expertise. And so it is kind of that humility that he always had, that I think, yeah, like David said, we all learned that because we saw him in the building. He just acted like another normal person, you know, and he was working harder than everyone else too,
Yeah.
right?
Yeah.
So that was, and Justin, you saw this all the time, that he was nonstop. So he just set this level of, you know, you outwork everyone, but you also remain humble. And especially if you're doing well in the stock market. And I think a number of people said it before, that they heard him when they did well. It's like, just remember, you put those pants on one leg at a time, right?
Yeah.
So because the markets can turn fast, and
Mhm.
and you know, teach you that lesson if you're not humble enough.
Yeah, I remember in the late 90s, you know, and again going into 2000, you know, and again my account was small, but you know, I was getting into Excel, loved Excel, and I had you know, some good years of performance, and I extrapolated out what what my returns were going to be at the age of 30. And he got such a chuckle out of it. He's like, you know, "Hey, you know, just, you got to recognize this is not how it always is, you know," and stuff. And there's still a lot more, you know, there's still a lot more to learn and everything. And you're right, he was definitely as good as he was always trying to get better, you know, always trying to learn more. And you know, to your point about the humbleness, when I first started, I started in September of 1997 in customer service, taking calls. And um, there was a program at the time where we were trying to take the calls in-house from CNBC. Now, you know, the number would flash on CNBC, the commercial would happen, and you know, there were a lot of calls that would come in. And you know, you don't want to leave them on hold for too long, because people are like, "Hey, I'm not gonna do that. I'm not gonna just, you know, wait forever to get my 2-week free trial." So we would have people from all over the company sitting down taking phone calls. So there I am in customer service, and when these commercials would come on, in would walk Bill O'Neill, sit down, start answering phone calls.
It's incredible.
And
Wow.
you know, and so I'm like sitting there, like I'm taking phone calls across from Bill O'Neill, Scott O'Neill, Wes Mann, the editor in chief, you know, people from upstairs, you know, and it was just, yeah, it was not like, "You're too good to take, you know, phone calls." Bill O'Neill is taking phone calls.
Yep.
And you know, he would answer the phone, you know, "Yeah, this is Bill O'Neill." You know?
Amazing.
Yeah, or let me tell, and sometimes his calls would go long. He was just supposed to get their information, but sometimes he'd be like, "Well, no, you're thinking about this all wrong." And it would turn into a little seminar. So yeah, it's definitely a very unique man. Again, I think we're all very happy that we got to work
And
with him.
Justin, just to really quickly end it, tell the quick story about when you took him to the airport, because I think
Yeah.
that's another, just an amazing story for what
Yeah,
Bill, how humble he is.
it's one of my favorites because certainly, this was in September of 1999 when I first started working for him. So I had been at the firm for 2 years. He tapped me, took me out to lunch and said, "Hey, I'm having my assistant move up into running the marketing department." So that's where the assistant went. She was running marketing and needed someone to replace her, and so I was tapped to come in. And one of the first, a few weeks into it, he has to go to the airport, and of course, I'm driving this beat up old Ford Festiva. And again, this is one of those cars that only had 3 cylinders, and that was on purpose. It's not like they forgot it. They did that on purpose. And so here I am. I didn't know I was going to be bringing him to the airport, and I'm bringing him in. I'm just like embarrassed, and he's talking about how great. Oh, I bet you get great gas mileage on this. And he talked about the beat up car that when he was a broker, he would park around the block, so that when he walked up to these mansions in Beverly Hills, people wouldn't see what kind of car he was driving. But he also told me, and this was what I really took from it. He told me how negative he was on the market. He told me how he had just sent a letter to 500 clients about how he thought we could be in for a big bear market. And this was in September of 1999. Now, a few weeks later, he gets back from that trip. We get a follow through day, and he's buying the heck out of stocks. He's right back up there on margin within a few weeks. And, he's buying some great stocks and has one of the best performances in the next 6 months from there. And of course, I didn't know that was going to happen at the time. But when he started doing the buying on that follow through day, I said, "You just sent a letter to clients about how bearish you are. Like, doesn't that your reputation, and he's like, "But it's different now. The market changed. You got to change with the market. It doesn't matter what I said, a month ago. That's irrelevant. That was a month ago. And now you got to take the data that you're looking at, the market that you're looking at now, because everything's different." So, hey, Dave, I'm going to give you the last word. I really appreciate you coming on, and you get the last word.
I don't know. I've just really enjoyed that last story and the anecdotes you gave, Irusha. Geez, the importance of right being flexible, being ready to go 180 degrees the other direction. I think is also important for success in investing, and that's something that I've gotten better at. I think I try to listen to as many smart, experienced people in the market as you can, and then from there build your own skills, your own your own style. Figure out also what time period works best for what stock you own and in what phase of the market. I think that's what makes investing in growth stocks challenging, but also extremely rewarding, because once you know that it's working for you, that this new stock that you bought, or this decision to go all cash and just stay on the sidelines to wait for a better market, it's really, really satisfying. And I think it's also like we know, learning a language, getting a degree in something that's very, very complex. No one can ever take it away from you, right?
Yeah.
And it just reminds me of how we can all be successful in the market and accumulate funds, and then those funds can go toward good causes or to reward yourself, and eventually funds can come down, but your knowledge and experience and wisdom never comes down. From there it can only go up, and then it can also lead to even more financial success. So I think we all hope that the methodology is not meant for a quick hit on making money. It's really changing your life, and for that, I really owe Bill O'Neill a huge debt of gratitude.
Yeah, there were some, repeated phrases that he would use often. When he would write things, when he would write letters, when he would sign books. Irusha mentioned one of them. You can do it. That was something that he often put in people's books. Go for it. Was another that was often used. And a lot of times when he was, referring to what the paper and what learning about investing could do for you, he would use the phrase, "It could just change your whole life." And that's, if I have any words of wisdom that I can share with our listeners, whether you're new or have been at this for a while, I would say those are the things, that Bill often repeated, and sometimes we could all use to hear, no matter how experienced we are. You can do it, go for it, and this could just change your whole life. So we really appreciate everyone joining us on this journey. And if all goes well, next week we're going to have Joe Fahmy on the show, but Allie is going to be taking the reins to help us out again while I'm on vacation. Thanks a lot for joining us this week, and we'll see you next time. Bye-bye now.